Good afternoon, everyone. I'm Urzen Pardiwala, the head of editorials of the MCom Committee of HR College. I would like to extend a warm welcome to everyone on board with us today for the Masterclass on Venture Capital, led by the distinguished Ms. Sonakshi Gupta from Aditya Birla Ventures. Just as our college pillars have guided us, we are fortunate to have Ms. Gupta share her insights. As we gather to unravel the complexities of venture capital, we extend our heartfelt gratitude to our MCom committee and faculty for orchestrating this event. Let's harness the knowledge presented today to illuminate our understanding of the business landscape. As we commence, I wish to extend our heartfelt appreciation to the guiding lights of HR College. Dr. Pooja Ramchandani, our principal, has steadfastly supported and guided us, instilling motivation to exceed our limits and attain excellence. Dr. Jasbir Kaur Sodi, our vice principal, has consistently aided us in charting a path towards achievement. Gratitude also extends to Professor Dharti Narwani, our dedicated faculty in charge, whose contributions have consistently propelled the success of the Masterclass League. Over to you, Viraj.
Good afternoon, everyone. It is my privilege to introduce our esteemed speaker for today's webinar, episode 2 of Masterclass League Season 3, center around the captivating topic of live venture capital. Please join me in welcoming the accomplished CA Sonakshi Gupta. With an impressive record of achievements, CA Sonakshi Gupta has demonstrated her exceptional process in the world of finance and investment. Her outstanding dedication and commitment have led her to attain remarkable accomplishments, including achieving an All India rank of 37 in the CA final examination and All India rank of 21 in the CA IPCC. CA Sonakshi Gupta's intellectual curiosity and inquisitive nature have not only driven her academic success but have also propelled her to engage deeply with critical financial matters. Her vast expertise is underscored by her diverse range of skills with leadership at the forefront. She has consistently displayed her leadership acumen, earning her recognition and respect within the finance community. A recipient of the prestigious Reliance Foundation Dhirubhai Ambani Scholarship, C.A. Sonakshi Gupta's exceptional insights and contributions have extended beyond the classroom. Her research has delved into compelling topics such as payment banks, the future or the past, and Panama Papers, root cause and its analysis, showcasing her ability to analyze and decipher complex financial issues. Currently serving as a VC at Aditya Birla Ventures, CA Sonakshi Gupta is a vital member of the investment team. Her role underscores her profound understanding of investment strategies and her ability to navigate the intricacies of the financial landscape. Valuable experience where she excelled as a manager within the corporate finance division of Ultratech Limited. Furthermore, C.A. Sonakshi Gupta's educational journey has been equally impressive. She completed her chartered accountancy studies at ICA. In addition, she holds a Bachelor of Commerce degree from NM College, further solidifying her academic foundation. So, it is an honor to have seen C.A. Sonakshi Gupta grace us with her presence in this insightful and thought provoking webinar on live venture capital. Her expertise and experiences are certain to enrich our understanding of this dynamic realm. Please join me in giving a warm virtual welcome to C.A. Sonakshi Gupta. Thank you.
Thank you so much, Viraj. I think that was a very impressive introduction. So thank you so much for that, Nurzin and the entire team. So really good. You can probably let me know how do you want to proceed and how do you want to structure this. You can accordingly kick it off then. And it's absolutely an honor to be here. I think HR is one of the renowned colleges of Mumbai, so it's an absolute pleasure to be here with the students and interacting and taking the session. So really looking forward to it.
Ma'am, I would really like to get an basically introduction of what exactly venture capitalists do or how to go about with it. we are looking forward to this needs to become budding entrepreneurs in the future. So anything that you believe can guide light to them would be great, ma'am.
Perfect. So what I'll do is I have a couple of slides on this. So maybe I can share the screen and we can keep
Definitely,
it
ma'am. Yes,
totally,
yes.
yeah, and we can keep it totally conversational. So there's any question or any query which anyone has at any time during the presentation as I'm presenting, you can always just maybe unmute yourself and speak up. I would love to address them, or you can always reserve them from the last as well. We can take it up. Whatever works for you, but would love an interaction and participative session. And if there is something more which you feel should get covered, as I'll show you the contents, please let me know. We can always digress from that and meet your expectations however you want. Okay, but just look forward to everyone's participation and a lot of questions, because we'd love to answer them and keep it as interactive as possible. Okay, so that will be the target of today's session. Just give me a minute. I will share the screen. And also just to confirm, like voice and everything is clear, right, for everyone?
Yes, ma'am.
Okay.
Yes, ma'am.
Let me know if you can see my screen.
Yes, ma'am. It's
Okay, good. So, venture capital is huge. So I have tried to cover as many, possible topics we can in this 1 hour that we have, and maybe touch the surface of some, go into depth or whatever. But like I mentioned, if you want to go deeper into any of them, or you have a specific question, because a lot of news is doing arounds about what's happening in the startup space, etc., would love to address them. Any case study that you'd like to discuss, etc., would be open to that as well. So it's totally free flowing, but this is how like these are the contents which I plan to cover. So let me know if you have any suggestions on this. So we'll probably delve into what is venture capital, who actually goes in for a venture capital type of funding, how exactly is a VC fund structured, the process of venture capital, different methods of evaluation of the investments that we do, and then of course it's an open Q&A which I've put in the last, but we can keep it throughout this session as well. But before I start, like I just want to understand if what is your understanding of venture capital, and how much do you all know about this space. So would love to first hear it from you guys. Also, is there a way that I can share the screen and also see you guys?
No, ma'am, I don't think that's possible on Gmail. But we can ask the students to unmute as and when they have doubts. And then towards the end, we can have a conversation, if that's okay.
Okay, sure. That's cool. But just to begin with, I mean, if anyone can just probably unmute and give me an understanding of, venture capital, or how do you all view this space or something like that? Guys, this is totally open. Come on, one answer.
Okay, ma'am. I'll give a small insight about it. What I know about venture capital, I guess venture capital is what after investment banking, like investment banking help businesses to get the first shares or startup. But venture capital is more specific business. Of the funds are available from the bigger investors, the big funds, the big sharks. Do we call? I guess that these are the insights that I know about it.
Okay, got it. Fair enough. I think closer to what it actually is. So let me start with it then. So first of all, talking about venture capital, it's a type of financing, right? Either you go, there are various ways of financing. You go take a loan, so you go take funds from your family, your friends, etc. So venture capital is going and taking funds from investors whose primary job is giving funds to people to start up. That is what venture capital is. It's a type of financing. It's provided to small companies and startup businesses, which are very early on, let's say 1 year old, 2 years old, 3 year olds, sometimes even based on a piece of paper and just a PDF, etc. Companies are raising capital from individual investors. That is what venture capital is. And it's given to those businesses which you believe that can have a long-term potential. So when we come to evaluation, maybe I can talk about how you figure out if a company has a long-term potential or not. But primarily, it's a type of financing only, which is given to your small companies and startup businesses. When it's given to a larger company, which is listed companies and all, we call it private equity. So that's a separate ballgame altogether. We will just stick to venture capital for today's session. So now moving on to who needs venture capital per se, right? Let's say there's a company who wants to start up, they need money. Now there are two options. Either you use your own money, you have your savings over the life, or you use your family, etc. You tap into your personal network to get money, etc., which may or may not be required to be returned. Or you go to external money, which is your banks, which you take a loan. But again, a loan means it's a fixed obligation to return, right? You go to VC funds where you give them a percent of the equity in your company. Let's say, right now you are the only owner of the company. Then you basically give them 1%, 2% ownership, etc. So they are now having a stake in your company, and in return for that stake, they are basically giving you money. So that is one way. So external money could be equity or loans. So when it's in the form of an equity is when we call it venture capital fund. So venture capital is basically given to some people who want to start up. And let's look at the advantage of venture capital over loans. If I would just ask any of you all, why would someone go for an equity type of a funding over a loan? Any thoughts around that? One,
There's no fixed costs
okay,
of
yeah,
interest.
correct. So that is there. And what else? So also remember that when you're starting up, right, in a venture capital, while you might have some knowledge and expertise in the space, but any kind of mentorship in that particular space will be of immense helping contribution, because probably investors are people who have a huge global network already. So they bring that expertise also when they partner with you, because now they are also a stakeholder in the company. So they will want the company to grow as much as possible. Whereas if you go to a bank, a loan is given and the work gets over there. So with equity, you're also finding the right partners who can help you and help the company to grow. So that is also one advantage you get in terms of equity. So let's look at the benefits of why you would go for venture capital over a debt. The first one, like you guys also rightly resonated with, is there's no fixed obligation of repayment of capital. Because obviously it's an equity. Whenever the valuation of the company becomes high, then you can take a call whether you want to sell that stake to someone else or not. Loan has a fixed time period, so you have to repay at that time. And of course, loan will require continuous outflow in terms of interest. Equity dividends is not really something which is very popular in the startup terminology. So it's just a capital which is returned whenever the money, whenever the valuation of the company is high. So there's no fixed cash outflow in case of equity as well. And then to meet certain business expenses. Now, every company which starts up, it is not profitable from day one, right? Obviously, because revenue comes in later. First you start spending on the business. You take an office, maybe you have rent, you hire people, then you have your salary cost, then you have your daily like printing, stationery, admin costs, etc. So these small operating expenses are first incurred, and then the money starts coming in. And if you have a very high tech product, you spend a lot on R&D, and then the subscriptions and your revenues from those products come in later on. So there's a lot of business expenses. And in case of loans, and how do you even repay it, right? Because there is no money coming in. So from where do you repay the loans? But in case of equity, since you have cash which is coming on day one, you use that cash to meet the expenses, etc. You burn that money a little bit, and then maybe 4 years or even 2 years down the line, if you start making money, then you can start building up equity and start returning it, or whatever it is, you can start building the value. So you get some time to actually burn cash to meet expenses and also find a product market fit. So that's also the next point, to scale business, team expansion, etc. Even if you already have a lot of money, but you further need more money to expand. Let's say even if you're a profitable company, you're making profit, you're making just say 1%, 2% profit, but you have bigger plans, you're very ambitious, you really want to grow your business, etc., and all of that. That cannot be done with the existing profits you make. Even if you put those profits back into the business and you say I will grow my business with that, ऐसा नहीं हो पाएगा, because you will need to grow aggressively. And in today's scenario where everyone is so competitive in every space, every product, there is so much of competition. You really need to grow super fast to stay ahead of the journey, right? So for that, you raise equity so you get more cash at that moment to grow fast. And once you actually reach a certain level of growth, then again you become a little conservative on your expenses, etc. So that too much of spending is also, we give it the term of cash burn. So basically use equity to burn cash to grow rapidly. And the one which I mentioned is timely advice and mentorship. Advisory and mentorship is something which is very common. So you have a lot of VC funds, like some of them are just specialized into gaming, some of them are just specialized into consumer brands. So they have a specific expertise they bring with them, and they're very good. If you want to go into that domain, then you would like to tap those kind of VC funds. So that is the entire reason why people go for venture capital over loans. Any queries on this slide so far before I move to the next one?
Clear on this.
Okay, great. So let's go to the next one on how exactly is a venture capital fund structured, right? Because it's not like just you and me coming together and we start a fund, etc. When you have a venture capital fund which are dealing with huge sums of money, like billions of dollars, and spread across geographies, etc. How exactly is the structure of a fund, and how is the revenue making mechanism of a fund? Let's understand that. So basically, every fund, okay, has certain investors, and the terminology for that investors is called limited partners, LPs, as we popularly call it. So let's say there is a fund, ABC is the name of the fund. Now, in that fund, let's say the fund size, which you also call as asset under management AUM, the fund size is 100 crores. Now, 100 crores will not come from just one person. You will tap into so many people. You will tap into individuals, high net worth individuals who have a lot of money to deploy. So let's say some amount of that fund will come from those individuals, like you have even your sharks and your angel investors, etc. So they might put into some funds like these. That is your one set. Then you might go into some really banks, etc., like SIDB, etc. They might also nowadays start investing in these funds. Okay, for them it's called investment into fund of funds. So they are also one set of investors. Then you go into some companies, family offices, you go into large institutions which are there abroad, within India, etc. So they will also invest into these kind of funds. You have sovereign wealth funds, like for example Tamasek, etc. So every government has a wealth fund, right? So basically, for example, your they collect pensions from the people of that country, or they collect some amount of money in terms of, let's say, your employee provident funds, etc. So all that is a part of government funds. Now they also need to make money on that. They will not just collect and keep it. So they will also invest this money into different asset class. Venture capital fund being one of them. So they're also like huge investors in all these venture capital funds. So these are 3 4 different types of investors who usually invest into VC funds, and they are basically called as limited partners. And then you have the partners who run the venture capital fund. They are called GPs, general partners. So they basically invest, and that's how the money for a venture capital fund comes. And obviously, better the fund, better the credibility, better the reputation, it becomes very easy to raise money, because then these investors will chase you. Whereas if you're a new time fund, you will have to chase these investors saying, okay, this is what our propaganda looks like. Will you be, interested to invest? And you will have to pitch your fund, which is always the case, right? Good performance is always chased by money. Which is true for a venture capital fund also. Just like good startups are also chased by a lot of VC funds, good VC funds are also chased by a lot of LPs. That's how the entire cycle works. Now you have startups. These venture capital funds will then invest in startups. Everyone has a different strategy. Some of them will invest in very early stage startups, which will be like, maybe just like an idea stage startup. Then you have some of them which will probably invest in a series A, series B startups. Okay, what is series A, series B? The first stage of funding for a startup is called seed. It seeds the idea into a nice product development. That is basically how it's logical to name it. And then you have series A. The next round of funding is series A. The next round after that is series B. So it just flows one round after the other, and you keep naming it. Okay. So basically, when you say series B, C, it also indicates the company is more evolved. So that's when, if you have a larger fund size, then you try to invest in these larger, late stage companies, as we call it. And then early stages or seed, series A, etc. But this is how the venture capital fund works. Let's say now the investors will invest in the VC fund. The VC fund will invest in startups today. But obviously, startups don't make money like we saw, right? You burn cash, etc. Let's say startups will start making money 4 years, 5 years down the line. So what happens is that the investors' money remains parked into the VC fund for 4-5 years. The VC fund's money remains invested into the startup for 4-5 years. After 4-5 years, what happens is that you either sell your stake. So let's say you invested 100 rupees today. 4-5 years down the line, because the company has grown in size, we'll see different methods of valuation, but you would be aware, like for example, your assets minus liabilities, etc. There's more assets coming in, so there's more profit, etc. So valuation of the company increases. So let's say your 100 rupees today becomes 1000 rupees after 4-5 years. So that's exactly a 10x gain, right? So where it becomes 1000, that's when you sell your stake to some other investor. So if you're an early stage investor, you will sell your stake to some late stage investor who comes in, after 4 years once a company is mature. So that's how the cycle works. And that's how the VC fund will make money. And once they make money, they will return the money to the investors. So basically, it works on the principle of huge gains. It's basically, if you have 100 companies of your portfolio, then maybe not all will make money, only 20 might make money, but they might make up for the loss of those 80 companies, because they make so much money, those 20 companies also, that even if the other 80 companies do not make loss, you are good with it. That's the basic fundamental principle on which a venture capital fund works. You work on enormous gains for those 15-20 companies that are invested. Okay. Is this much clear? Any queries on this?
Yes, ma'am.
I can't see any of you guys, so I'm just assuming you all are really following it. And if you're not, would love it for you all to just stop, or if you just want me to repeat the entire thing, would be more than happy to do it. So should I move to the next one?
Yes, ma'am.
Okay. So now I'll just explain to you, which I just explained to you right now. You have seeds, Series A, etc. So from 2015 to 2021, this is just a very, very interesting statistics. Okay, 2,863 companies were in the seed stage. From that, only 18% reached Series A. And from that, only 6% actually reached your reached Series B. And from that, only 76 reach Series C, and only 25 make it. So that is the percentage of, basically your companies which move from C to Series C. So that shows the risk basically of investing in early stage. If you come in at a seed stage, you are highly risky, because your investments are highly risky. Very few of them will move to the next stage. But then you spread your bets across so many companies, at least assuming 15-20 will do well, and that will give you all the money that you need. But this just shows how many companies die down at each stage. So while the startup world might look very fancy from the outside of it, it is not, because so many companies, the later the company is it becomes more difficult to raise capital, and also to keep your business model sustainable. A lot of unicorns also, which you've been seeing nowadays, right? Like even Zomato, for example, etc. Then they are reaching profitability now. So that is because they have been just burning cash, and they only, were just putting all their money into expenses growing their business. So if you cannot maintain that profitability now, the company will die down. So that is the reason so many companies die down from the C to Series A, B, C, etc. And this is exactly how a funding looks like for a VC fund as well. So earlier you come in, the risk is high, but then your gains are also likely to be high, because obviously the earlier you come in, the valuation is less. So it's likely to increase. If you come in from a series B to C, maybe the valuation might just increase 2x, but then the investment is less risky. Whereas from C to Series B, the valuation might increase 10x, but the risk is also high. That's the entire funda on which this fund works. So, what an investor will look for is, he will try to diversify his investments as much as possible to mitigate risk. He will either try to diversify into different sectors, different type of geographies, etc. The different ways of, diversifying investments to mitigate risk. Obviously, high risk earned, high return, and earlier the investment, higher the chance of valuation expansion. Is this clear? Any queries on this so far?
No, ma'am, no queries.
Okay. So we move to the next one, which is basically the process of venture capital, right? So how do we go about identifying opportunities, and where should we invest our funds? So let's say now I'm a part of the investments team. So like my job is entirely end to end. Everything right from the time, I get an opportunity, even finding an investment is my job, and closing the investment, monitoring it till the time we exit it is my job. So it's a very entrepreneurial kind of a profile which a venture capitalist has. So very first one is finding that investment. Why and where should I invest the money? So first thing is, now that everyone knows, okay, maybe I'm looking at investments, etc., people might reach out. So you'll have a lot of applications on our website. We'll have a lot of people reaching out through LinkedIn, etc., saying this is something they're working on and would love to engage and understand if this is worth pursuing and something which you would like to invest in. Cold mails, okay, like people might just randomly drop a mail saying, okay, this is what we're building and we would love to have a chat. That's what we call as inbounds. Then we had outbounds, where since I am also tracking few sectors, okay, which is more obviously productive than inbounds, because inbound has a host of investments which might not even be relevant for your thesis. Outbound is basically me tracking many sectors, which is consumer tech, etc., b2b commerce. I'm reading a lot of reports industry within India, globally, seeing what trends are emerging, talking to a lot of people from the industry, seeing if something is worth investing, how is it going to pan out 4 to 5 years down the line from today, and then finding out which are sectors within that particular sector, like subsectors or trends which are worth investing in, which business models might work, which have worked in the past, why they did not work, etc. Studying all of that in detail. And based on that, making a list of business models which should work out, and accordingly reaching out to startups which are working in that sector. So that is highly focused sectors, and that's how most of the investments are also made. And then you have across the ecosystem. So you're always, it's a very close knit network, and it's very important for you to be resourceful in terms of the people you interact with, etc. So you interact with your fellow VCs, etc., and understand from them who are working other funds, what trends are they seeing, if they know of any investments which are doing well, and if they are raising funds, okay, maybe their own portfolio company which is raising a next round, so whether something that we can come in, etc., is there a way we can add value. So that is one way we do it across the ecosystem. A lot of VC events keep happening where startups and investors meet, understanding what they do. And then you talk to a lot of angel investors. So angel investors are basically individuals. They don't run a VC fund, etc. They come in at a very idea stage. Like if you guys have watched Shark Tank, that was a perfect case of angel investing, where those 5 sharks who were sitting there at the table were basically our angels who came in at a very idea stage, very early stage, and were investing like lakhs or crores of rupees, right? Which is something which is in an individual's capacity. VC funds would definitely invest much more than that. So that is our angel investors. So keeping a close tap on them and having a network with them, because as a VC fund, they will supply the investments to you. They will basically provide you leads as to which investments are going to go into Series A, B, and then you can look at them from a potential evaluation standpoint. So that is your first channel, which is sourcing. A lot of time is spent on identifying the right investment opportunities. Then comes to the evaluation phase, where you spoke about identifying companies which have a long-term potential. So how do you do that? So first and foremost is understanding the founding team, their pedigree, their experience. Why is this that they're doing it? What is their motivation for it? Because they have to be committed to the business for the long term, for their life. Employees might come and go, but they cannot afford to leave because people are betting on the team. So doing strong reference checks, background checks of founding team, understanding the motivation, super critical. Market sizing. If you are building a particular product, or if you develop a particular technology, you are need to understand, is there a market for that particular product? So you will see, let's say if you're developing soaps, you're building a new type of soaps, handicrafted soaps, and you will have to see what is the price point that you're targeting and which cities are you targeting. Let's say you're targeting Mumbai and targeting premium and elite people of Mumbai. Then you will find out what is the population of Mumbai, how many people will have the purchasing power to buy that soap. There are a lot of macro reports which will give you those trends, and based on that, you will find out, okay, these are the potential people who could buy the product of soap. And then based on that, you will identify, okay, this is how big the market in Mumbai can get to. So let's say even if it's sold to all the people, or if it's reached only to 1% of the people, then how big can the market get? So that is very important. And if it is something which is big enough, then okay, it means it has a good target addressable market. We call it TAM popularly. If it's small enough, then you have to see if it's really worth investing, because how big can it actually grow, right? You're investing in the company 5 6 years down the line. So even if it grows at a very rapid pace, how big can the market get? Then defensible product or tech. Very important is that defensible, which means your product should be unique, okay, and it should have a strong moat. When I say moat, it should have a strong competitive advantage. So for example, if you are building soaps, okay, so why is it different from other soaps in the market, such a crowded market? So you should be able to defend your product or tech against the other existing competitors. And then every sector will have certain key performance indicators. If I'm talking about fintech, maybe the prices burst. In case of let's say a tech product, then maybe number of users who come daily, active users, retention, etc. In case soaps, I will basically look at your gross margins, very critical, your unit economics, how much average order value are people spending on a purchase, and how much of repeat purchase happens, etc. So these are performance indicators specific to different sectors that you evaluate. Then commercial, legal, and financial due diligence. Usually external firms are hired for this. When I say commercial due diligence, for example, I'm looking at soaps. What I will ask the founder is give me a random dump of buyers who have bought the soap in the last 1 year. I will literally call up these. We make a questionnaire of questions that we want to ask these buyers. How is the soap? How do you find the price? How is the quality, etc. A lot of 10, 20 questions. I will like to have consumer service, which you also get randomly, right? I will call up these customers and ask them, okay, did you like the product? Those questionnaires, and based on that, I will see if it is something which you're actually enjoying and what is the customer feedback for the product. Legal is something which is very uh, it's very theoretical in terms of a firm which does it. It's not to do with operations, but in terms of all, if there's any litigation pending, it becomes very important, especially now that so many foods are happening at a startup and investor level. So whether all your compliances are in place, your taxes are in place, GST, etc. So all those kind of things super important. Financial due diligence is more like an audit. While the founding team has given us their numbers, their financials, but who will actually tell us if those numbers are actually right? So financial due diligence team is hired to go back and vouch those numbers. So they will ask them the back records. It's like an audit. Okay, they will ask the team, the founding team, okay, how do you derive its numbers? If they'll show a sale of 100 crores, they'll be like, okay, show us sales receipts. They'll see the entire trail if those numbers are accurate, because we are going to invest based on those numbers. Anyone can fudge numbers and just give us an Excel plan, right? So we need to ensure the accuracy of that plan. And then, of course, we do a risk return analysis. If we are comfortable, with all these things, that's when we go ahead, we do a detailed risk return analysis, which means if we invest 100 rupees today, based on a target market size, if it reaches to 1% of that also, this is the revenue it can reach to. And on that revenue, let's say it can get 2 3x multiple. So we do a multiple comparison of listed companies and other companies in the space. This is the multiple it can reach to. So this valuation can reach to 4 5 years down the line. So if you invest 100 rupees today, how much can that 100 rupees become in the next 4 5 years? If it is a good size and amount, which means it's a good company to invest in. That's how the entire evaluation is done. Then once that is entirely done, basically we have the transaction closer. We also take it, we have an investment committee. Every fund has an investment committee where you take any investment, which is like a independent third party view of whether investment should be done or not. They are experts and they've been like veterans of this particular industry. So once their approval is also being received, then we go to a transaction closer, which is basically all your documents which are in order. Like you have a share purchase agreement, share subscription agreement, which is basically all your legal documents stating what rights the investor has. Okay, how will you invest, whether through equity shares or compulsory convertible preference shares, converted to equity shares after some time, what is the exact stake you will get, etc. All of that is done in transaction closure. And then once the entire transaction is closed, you will keep monitoring the portfolio on a month 2 month basis, or whatever periodic interval you want to do it at. So you will keep asking for the MIs on monthly basis. If there's any major event which is worth highlighting, which you should know of, and let's say if a company has reached a sizable level and they're doing a next round, whether should the investor exit at that round or should we wait for the next round, etc. All of that is a part of your portfolio monitoring process. So this is exactly what an end-to-end process and a day at a venture capital fund looks like. Any questions on this? No questions could either mean you guys are understanding everything, or maybe I'm doing a really bad job and you're all super confused.
Ma'am, actually, the content is really engaging, and we have kept the questions towards the end.
Okay, sure, works. So I'll move on to the next one then. Now, like I spoke about evaluation, and in evaluation, risk return analysis involves valuation of a startup, right? Different methods of valuation. So the 4 most commonly used methods is what I've compiled over here. First one is your discounted cash flow. Have you guys studied discounted cash flow in your syllabus?
Yes, ma'am.
Okay, perfect. So I will not go into depth of how that is done, but that's basically used for those companies which are series AB plus, because there should be sufficient data for you to actually understand what the future cash flows will look like, what is the past trend in terms of growth look like. That's when discounted cash flow is used. Publicly traded comparable companies, like I mentioned again, to let's say a companies in that space is already listed since 4 5 years. So at what multiple of revenue or EBITDA is it trading? So So that will give us an idea of if our company, which we are looking at investing into, gets listed, let's say 4 to 5 years down the line, or gets stabilized and really expands, what valuation can it seek at that time? So, we use multiples of listed companies to arrive at that. Comparable investment transactions. So, for example, this is used more to arrive at the multiple you want to invest in today. So, for example, if I'm investing in a company, I want to set the valuation today that I will come in at this valuation. So then I will use that, okay, transactions which have happened in that space maybe just few months ago, because now there's so many funding rounds are happening day in, day out, and in similar industries. So I will use that as benchmark. Maybe some M&A has happened in that particular industry. So I will use those transactions, etc. I can use that for, let's say futuristic projections also. It works both way, but it's being used more actively for present valuations. That's where comparable investment transactions comes into play. Then you have annual recurring revenue based valuation. Annual recurring revenue is called ARR, which is again a very common terminology which is used in this industry. Okay, a lot of people have nowadays started using it for consumer brands as well, which does not make sense, because it makes sense only when you have like subscription revenues, because a consumer subscribes to something. So the revenue keeps coming month on month. Like you subscribe to Hotstar, Netflix. It's a regular monthly income that those companies receive, right? Consumer brands, you buy today, you buy a soap today, you might not buy it the next time, the same brand. So that is why that's a very false way of doing it. But ARR is used a lot for tech companies, subscription based, where it's a recurring revenue. So multiple of that sometimes might be used as a valuation. So these are the 4 methods of valuation that we popularly use. So this is basically in broad how the entire venture capital process works. I've covered things on broad level. Something you want me to, given the time that we have, the limitation, but open to Q&A, and if there's something you want me to cover in detail, feel free. This now it's an open forum for you guys.
Hello.
Yeah.
Yeah, ma'am. I've heard that to get into venture capital, it's a very competitive field, and only like CA rank holders and all, can get a job in this field. I'm pursuing CMA. So, is there any scope for a CMA to get into this field?
Yeah. So you're saying for a non-rank holder CA.
Yes, a non-rank holder CA or CMA, like cost management accountancy, who has gotten a rank.
CMA. Okay, got it. Yeah. So I'll tell you what happens is nowadays, every VC fund also looks for diversity in candidates, because given the breadth of the industries that they're evaluating, they'll evaluate industry in, let's say, core tech. So they might hire computer science graduate for them. Core fintech, they might hire CA for them. Core cost optimization companies, like you have a lot of these SaaS companies which are just working on how they're optimizing cost. So those kind of evaluations may entail people from different backgrounds. Now you have agri-tech companies, so someone maybe who's worked in, like a sustainability space, etc. So they also demand a lot of diversity. So you can show that, maybe how you probably bring a diversified mindset to the table, and how you'll be able to add value different from the others, it becomes easy. So because nowadays that perception is changing, they're hiring others as well. So, and the best way to enter that is through an internship. Maybe you reach out to VC funds and say that, can I intern? So that way you can show your performance. So they may not have a fixed obligation to pay you, etc., but they will definitely be able to judge your caliber. And if they like you, then most of the cases they might also take you full time into the team.
Okay, ma'am. Thank you.
Yeah.
Okay, ma'am. I have a question. Thank you for such
Yeah.
great insights. It was a privilege to be mentored by you. You are an inspiration to many of us. Like you already briefed on the how you get to VC. We would love to learn about your experience of getting into a VC.
Sure. So let me I think it was mentioned in the introduction, I was working with Ultratech, right, into corporate finance earlier, and the VC fund was just being set up. So I was also more like a part of the founding team of this VC fund right from the start. So this venture capital fund at Aditya Birla was set up in November 21, and that's when I also moved from Ultratech to this fund. So basically it was just I was kind of reached out internally based for this opportunity, and of course I showed a lot of interest, etc. So had a series of rounds of interviews which were more like case studies, with the head of the fund, with the CFO, etc., and with the promoter himself. So 3-4 rounds around that, And that's when I probably got a chance to actually be a part of this team ever since, and it's been a great learning so far. So like the entire process of a VC fund is what my job profile looks like. But yeah, so interviews were like basically 2-3 rounds of interviews where I was asked to do a sector study in a particular sector, give my understanding of why is that a good sector to invest in, and then a round of interview with the CFO and the promoter as well.
Okay, thank you, ma'am.
Yeah.
Ma'am, what trends do you currently see in the startup and venture capital landscape?
Right. So when you say trends, are you talking about sector trends, number of deals, or is there something specific?
No, ma'am, not something very specific.
Got it. So, couple of points that we divided answer into 3 parts. In terms of the trends, okay, first of all, funding trends. So, right now, as you would have heard, the funding winter, it's real. Like the funding is actually slowed down. Like, let's say the amount of funding into startups is half or even one third of what it was maybe a year back. So, and the reason is because obviously companies are correcting. The cycle is very natural to the industry. It had come in 2008 last, and it's very important for the industry to correct. So the number of funding deals have actually gone down, but seed stage continues to remain quite high because obviously they're giving scope to new ideas, etc. Series A and B is when they're looking for profitability, and very few companies are able to demonstrate that. So late stage funding has gone down, early stage funding pretty much the same. In terms of sectors, people are now also resorting back to like traditional sectors like consumer brands, B2B commerce, and with a new unique mode to it. So B2B commerce is like, for example, let's say supplying building materials. The contractor would also earlier supply building materials to companies, but now there's a company which is coming in ensuring higher quality, etc. Those kind of sectors are picking up. AI is picking up big time. You have generative AI where something as simple as you draw an image, you ask it to convert it into something real, like you draw like, or you just say burger, it will actually make an image of a burger. You describe how you want it, and just put a description. In theory, an image will pop out of out of that description. So that's what generative AI looks like, and that is real use cases, chat gpt, etc. So AI is really picking up. New sectors are emerging like your space tech, etc. So something where you're just looking at satellite monitoring, defense systems, drones, etc. So all these new technologies are really picking up, but it's very early to say how an investor will exit from these companies in terms of, let's say, if they've invested now 4 years, 5 years down the line, what will be their exit route? Will they be able to sell the stake, the company, do an IPO, etc. But in terms of sectors, these trends are really picking up. And in terms of funding in startups, it has really gone down significantly because people are now also resorting to more of a deeper due diligence, which is a good thing. Because last year, a lot of deals happened out of FOMO, just a fear of missing out good deals. So that's why people would just even wire money without even understanding what in depth their MIs look like. So a lot of that used to happen, just to rush and deployment pressure, etc. So all of that is now correcting, which is a good thing, something which happens in this industry, and it's happening at the right time right now.
Okay, ma'am. Thank you.
Yeah.
Can you share some tips for early stage startups when it comes to attracting venture capital funding?
Right. So I think couple of things which an early stage startup should look at. Like I said, if you're building a product and service, you should see how large your market is. So you should really back that up with data if you're taking it to an investor of why your market is big. And market should be big for a specific product. Now, when I say soaps, you should not just say, "Are soap market itna bada hai," or like the bath care market is so big and that's a time is big. No. What is the specific, what is your pricing of that particular soap? Are you looking at a particular brand of soap, etc.? So within that soap market also, let's say your market might just be 10%. So you should really drill down a market for your product and come to what your target addressable market could look like, total addressable market could look like. And you should have a big TAM. So anything which is small, then it's not a sustainable business model, right? That is very important. Secondly, your competitive landscape. If you are building something which is very similar to the others, what is it different that you are doing? How will you be able to attract users? And if it is something totally new, then is that even needed? What is the utility of that? Why wasn't there all the while? So back it with problem statements people have faced, etc. That is second. And third is, if it's a global trend, maybe people are doing this globally and you're bringing something new to India, why is it that's going to work for the Indian market? So also, benchmarking it to a global trend will also be very useful. And fourth is, of course, is face because people will ask for samples, people will ask for samples. So these are 3-4 things you should keep in mind while even building the entire initial pitch deck for your startup. And very important is to tap the right investors because people end up going to the wrong investors. If you're very early stage, your ideal mechanism or channel would be your angel investors who are individuals, or micro VCs, incubators, accelerators. Might not be a proper VC fund in the first stage. So very important to identify the right side of investors also. Otherwise, you'll be wasting your time and getting demoralized for no reason.
Ma'am,
Yeah.
aims for investment in the form of an equity, but
Hmm.
when he like pitches to the investors and the investors
I lost you, Pooja.
equity and yes, ma'am.
I lost you for a few seconds in between.
Oh, sorry, ma'am. I'll start again. So, if a
Yeah.
startup aims at gaining an investment in the form of equity, but later on, when the startup pitches to the investor, and the investors are interested in partly giving equity investment and partly debt investment, so
Hmm.
should the startup like consider the debt part of it, or should not take the investment because it includes debt and not entirely equity?
It's a very subjective call on the founder. If he's okay with that fixed payment obligation, if he thinks he will have sufficient funds to incur that fixed obligation, then it's okay. If not, then he should push for equity only. So it's a very subjective to which stage of his cash flow also he is in. I mean, it's very difficult to generalize it, but because some people also prefer debt because they might not want to dilute the stake in the company. They think the company will do very well and they don't want to share the equity, so then they think that he can easily repay the debt a few years down the line, etc. So I think it's a subjective call based on the stage and performance of the company.
Ma'am, if we talk about the initial stage, then
See, initial stage, I think equity is preferred so you don't incur a fixed payment obligation. But within initial stage also, it depends. If you have like some a lot of the startup founders who start up, they have a lot of cash balance in their personal capacity as well, which they plow into the company. So if that's the case, and it also depends on quantum of the loan you're taking. Let's say if it's 10% debt and 90% equity, and depends how big that amount is. So again, coming to my point, depends on the cash balance in the company, depends on the split between cash and equity or debt and equity, and then you have to take a call. So if your debt is, let's say, 5 to 10%, and he has sufficient cash balance to service that next 2-3 years, which is reserved just for the debt, he can do that as well. So it depends a lot on the position of the company.
okay, ma'am. Thank you.
Yeah. I think someone had put something on the chat box. Um,
Yes, ma'am, I'll read it out.
yeah.
The first question: what are the main points that the investors or venture capitalists consider before any investment?
Okay. So you're saying what do VC funds consider for investment? Is it
Yes, ma'am.
right? So I think those evaluation points which I had put on my slide, basically, seeing the founding team, evaluation, the market size, industry expertise. These are a couple of points that investors look for while investing in a startup. If that answers the question, I mean, I'm not sure this is what was expected, but that's what we look for.
Yes, ma'am. How do we reach out to traditional sectors like handloom or artisans, considering that they are very remote, and what are the future prospects for them?
Right. So when you want to reach out from an investment perspective, um, see, while there, of course, it's a good sector to fund, etc., might not be the best money making startups, right, from a pure VC standpoint. But a lot of funds are there in the market which are focused on sustainability and social innovation, social entrepreneurship, etc. So these guys literally have a team which is on the ground, which goes to a lot of places. They connect with NGOs. They have an entire pipeline. They regularly interact with maybe teachers in that city, etc. Understand their students are building something new, and then if they see a startup, then they basically provide mentorship, advisory, etc. to those students. And once they're at the funding stage, then they help those startups get the funding and scale up. So I think these are the two main points which I would say investors look for while investing in a startup. usually have a CSR target sometimes. Sorry, VC funds have a CSR target or certain corpus reserve for that, or you have certain funds which are focused on social innovation, etc. So then they kind of their objective is only this, so their entire strategy is built around reaching out to these parts of the country.
Hello, ma'am. I have one more question.
Yeah.
So, when does the venture capital fund decide to sell their stake? Like, is it some like they determine the profit in advance, the profit at which they want to sell in advance, or what is the procedure?
Right. So, not really. So, it's very difficult to say that I will, sell at this profit stage. Let's say now we are investing in a company. We've come in today. Um, Now, every time, let's say we came in at a Series A. Okay. Now, the company will raise a Series B, it will raise a Series C, Series D, etc. So, whenever it is raising a Series B, let's say 1 year down the line. Okay. So, we as existing investors, we know what valuation the company is raising Series B at. Based on that valuation, we will see when we had come in versus what is the valuation now. If that is lucrative enough, then we can decide, okay, we want to sell the stake or we want to continue to remain invest in the company because we see the valuation is going to only get higher and higher from here. Then again, the Series C is going to happen. So then we will say, okay, now Series C, this valuation happening, we'll again compare to the valuation which we came in. So then we will say that is, a big enough jump whether we should exit or not. So basically, we will evaluate our stake at every new round of funding and then we'll decide where to sell it or not. In between these rounds, if you want to sell it, might not make a lot of sense because, I mean, there's already like in Series B, Series C, if you there already investors are willing to buy some stake in the company. So if you want to sell your shares between these funds, you'll have to find new investor, or you'll have to just initiate an entire long legal process. And why do you want to just sell your shares in between nothing, right? Unless of course the company's gone for a toss. So then at each basically new stage of funding, you evaluate what the valuation is, what multiple are you getting of your current stake, and then you will decide, okay, if it's worth it. And like VC funds have a threshold in terms of the return they want. They want a 15%, 20%, 25% return. So at each stage, they will evaluate, okay, this valuation is giving me 15%, this is giving me 20, 25. So if that threshold is crossed, then they will see, okay, should I basically exit or should I stay invested for some more? And if it is below the threshold, then you will basically decide, okay, then let's just wait and see if the threshold can be increased in the next funding rounds.
Thank you, ma'am. That was very informative.
Okay.
Ma'am, we would also like to know if there are some common misconceptions that entrepreneurs generally have towards venture capital.
Oh yeah, the lot of misconceptions that they have. I think the very first one being, you need to have a very ITIM tag to get funded, etc. ऐसा कुछ भी नहीं है. So there are a lot of top funded startups which are being chased by the top-notch investors, but they have a super strong experience and a knack for problem solving, very good with operations. So they're also very well funded, so you don't have to get worried about that. Secondly, you should not worry about VC funding. If you receive VC funding, which means you're doing well. A lot of startups which are bootstrapped are also doing extremely well. Zerodha and Zoho are, I think, perfect examples of that, right? So you should not build a business thinking I have to reach a unicorn valuation, I have to raise VC funding. You should build a business thinking if I even do it for my own money and bootstrap it, how big can it get? And that way you will build a profitable business from the start. That's how Zerodha and Zoho have been able to crack it. Even the current unicorns, most of them are not profitable, right? So that misconception should move out like, okay, funding means I'm doing well. Not at all. That's not an indicator. And thirdly, larger the funding, which means larger I'm doing well. No. A very good company might raise less capital because they are burning cash optimally and focusing on growth as well and having strong unit economics. Because very easy to raise large capital and then keep burning it, etc. So it's very important that you have to have very strong unit economics and you're making money with every sale. So these three misconceptions are there among entrepreneurs. Very important to clear.
Thank you, ma'am.
Yeah.
Ma'am, how do you assess the potential of new technology or innovation when making investment decisions?
Yeah, that's a very interesting, good question. Especially, I can say that even for space tech, right? A lot of space tech startups are coming in. How will you even evaluate if that is making sense? The best way to do it is talk to experts in that field. So let's say if not every VC fund will have expertise in every field. So let's say if it's a path-breaking innovation in dubbing, or this is a totally off field. I've given an example of dubbing or something like that. You talk to actually maybe dubbing artists You talk to people who are working in the traditional field, saying, "Okay, if this new technology will come, is it going to help you?" Second, you might just reach out to, that's where VC fund network comes into play. You might reach out to global experts who've actually, seen that trend, etc., and ask them, is this something which is, going to stay in the globe for, let's say, a few years? How does this trend look like? So talking to experts, talking to people who've been in that space but not using technology, who've been traditionally doing something. So will the new technology help them? And then maybe once, like you have an alpha beta stage of a product which comes out. So if a tech has come out, you have an alpha beta testing where you just give it to select 10, 15 users to understand how is the product, how they're using it. So you can do that kind of a testing. And even VCs can then take feedback. VCs can also be one of the users of that particular tech and see if how's the interface, if that is something which is actually going to make sense or not. As a layman, you can obviously understand na, कि ये कुछ मतलब help करने वाला है कि नहीं. So these 2-3 ways you can actually understand the tech is making sense.
Thank you, ma'am. And could you share some resources or books which we can refer to get more idea about the venture capital funding field? Like,
Right. So, I mean, there are a lot of fund, like you want to understand about fundraisers which keep happening, or what venture capital also is different. Like, if you want to understand recent fundraisers which keep happening, then there's a source called Intracker, which gives you a funding activity on a weekly basis, which startups have done good, which have raised funding, etc., early, late stage. That's for just VC funding. In terms to understand how the VC world works, I think I'll have to look up a few books because it's all been very practical for me, but I can maybe suggest that to you. I can get in touch with me. I can suggest a few names. But articles, Ken is very good. Also, Ken Morning Context. They really let's say they diagnose business models very well in terms of what is doing well, what is not. So these are 2-3 ways in which you can probably understand daily articles if it's doing well or not. Then even your papers like Mint, etc., they have a ET Times, they have a tech section nowadays which has started, which is one page of just on funding, etc. Maybe you can track that as well. Specifically broadly on venture capital, I can get back to you if you want to read a book.
Ma'am,
Yeah.
while raising the new round of investment, can the new investors affect the stake or the control of the previous investors in the company?
Good question. They can. So it depends. Basically, the new investor is putting in a lot amount of money. Okay, so then obviously he will dilute the share of the existing investors, and the existing investors cannot say anything because either they also put in equal amount of money, or they have to get their shares reduced, and basically some equity stake is now shared with the new investors. And obviously, the new investor comes in huge amount of capital. He might take additional rights over what the existing investors already have. He might want more information on the company, which the existing investors might not have. Those kind of rights he can take additional. So the question is, yes, he can change the rights and the amount of stake, etc., in the company, etc. And that's where a lot of conflicts also happen. Yeah.
Ma'am, one question. Maybe this would be the most specific question. You must have already seen the upcoming making of resumes with attaching photos of themselves. What's your take on this? Does this attempt make one's resume stand out, or the old ones are the best ones?
Yeah, I don't think it has a lot of value addition, honestly, because I tell you what we look at from a resume point of view is obviously the education qualification. If you're hiring investment team, his experience, because if you're looking for a particular type of an experience, let's say we were looking for someone who was good with SaaS or tech, so then maybe if he has some experience in that genre, etc., there is something we look at. And then of course his interest and aptitude for that field, and it's just talking to the candidate, of course, once he's shortlisted. But a picture or something, that is not something which actually matters to us. It's not a big value addition. And nowadays, since everyone is using LinkedIn so actively, you just end up looking at people's resumes on LinkedIn as well, and then seeing how basically what their pedigree has been like. So not really. The answer is a blank no.
Okay, ma'am. Thank you so much.
Yeah.
Ma'am, while making an investment, do the investors consider the entrepreneur or do they consider the business that the entrepreneur is bringing up?
Both are equally important. See, earlier the stage, entrepreneur becomes more important because उसने business तो बना ही नहीं अब तक. Sometimes it's just an idea in his mind. So you need to have, you're basically betting on the entrepreneur. He will execute that idea very well. Later in the stage, maybe you can also get other experts. You can hire some specialized people to execute the business. So let's say earlier, in early stages, 30% maybe business, 70% entrepreneur. Later on, it becomes 50-50, but both of them are equally important. Does it answer your question?
Yes, ma'am. Thank you.
Okay.
And one last question from at our end. What are some qualities or characteristics do venture capitalists look for in an entrepreneur while considering an investment?
That's like a good question, interesting question. So I think they should have a very good problem-solving capabilities, right? um, Irrespective whether that problem is something they solved in the past or not. Their knack at solving and how will they approach a problem, break it down into bits and pieces, take it one by one. How is their temperament while solving the problem? Very important, and that is something which you can easily gauge from the conversations that you keep having one after the other. Their resilience, because in times like this, when you might not get the best business, right? How resilient would they be? So resilience is extremely important. Their ambition, because only if you're really ambitious can you grow the business really big, right, and scale it to a large revenue. So ambition is very important. And very good people skills, because see, when you're entrepreneurs, you're going to be basically a CXO of a company. Once a team grows and expands, a lot of people issues are happening in startups right now, and that is why people are dropping off. So it's very important to have very strong people skills also, so that you can take the team along with you as you progress and expand rapidly. So these three four skills are extremely important, and which you can gauge from conversations as you have. So it's something very important to gauge.
Thank you, ma'am.
Yeah.
Ma'am, what type career involved in venture capital world and how to get into?
How to get into, like I said, see, sometimes VC teams are extremely small, okay, and very few VC funds are basically there in the country, right? Let's say out in the entire country, you might have 200, 300 people which are actually into venture capital. So best way to crack it is either apply to VC funds through people. Maybe if there are vacancies, reach out to people at LinkedIn, etc. Their funds are hiring, not hiring. They might then get in touch with you if they're hiring. And secondly, try to maybe write for internships if not hiring immediately, because in case of hiring, then the VC funds are also obligate and they don't lay off people very fast, because once you're actually part of the team, then you're part of the team for long, right? So then and what if, and it's a risk for them, because what if they don't the candidate does not meet their performance standards, etc. So maybe you can reach out for internships, and if they have like a strong internship vacancy, they can probably give you a chance and you really perform well there. So if you can crack that performance expectation, they might also offer you a full-time role. So I think
So
these are two best ways.
yeah, actually मैम किस टाइप का रोल ऑफर करते हैं बेसिकली वेंचर कैपिटलिस्ट?
Sorry.
किस टाइप का रोल ऑफर करते हैं, मतलब किस टाइप के रोल होते हैं उधर वेंचर कैपिटलिस्ट?
तो वेंचर कैपिटलिस्ट का रोल इन्वेस्टमेंट्स होता है. सो उसमें लाइक इफ यू वांट, लाइक इट डिपेंड्स. वैसे तो और भी रोल्स होते हैं, लाइक इफ यू वांट लाइक अ फाइनेंस रोल, सो विच मीन्स यू विल नॉट बी इनटू फ्रंट एंड इन्वेस्टमेंट्स. यू विल मैनेज द फंड अकाउंट्स के पैसे आ रहे जा रहे हैं, हैंडल कंप्लायंसेस. वो भी टाइप का रोल होता है वेंचर कैपिटल फंड में. सेकेंडली, इफ which is, I don't think it's relevant for you guys, but they also have like marketing, communication, branding roles. So you have a lot of podcasts with VC funds do. So वो सब एक communication run करता है. So they can also build the branding, keep it aware. But you have fund accounting, legal compliance. So you can have a finance person at a VC fund. You can have a legal person who will handle the legal documentation, etc. Then you also have a corporate development professional whose job is only if your portfolio company is raising a next round. He will keep connecting with your fellow VCs, etc., and tell them कि ये company पैसा raise करी है, so that he is getting new investors for that round. Because you're already an existing investor, आप पैसा डालोगे और investors चाहिए. So that role is called corporate development profession. He will only sell the portfolio companies to other investors and basically promote the portfolio company के saying कि आप इसमें पैसा डालो, conversation करो, etc. And the last one is of course the front end investment role, which I mentioned, right? Sourcing, evaluation, portfolio monitoring, which is entirely end to end. So these are different kinds of roles VC firms offer.
So you said that as investors invest in these companies, right? They get a stake in the company. So basically, they also have a part in the decision making of the company. So I was just curious: do these VC firms have strategy teams also, like content strategy? consulting teams in house?
Yeah, that's also a good point. Sorry, I think I missed that. Yeah, so they have basically it's called operating teams. So they basically so those investors who are basically lead investors in a company. So they have strong operating teams who would closely work with portfolio companies to increase yeah, to basically decide the strategy, business plan, expand the business, and it's so that basically you can increase the value of the company as and when you go forth. So yeah, operating teams is also there. Yes. A lot of times the investments person will also work strongly with the portfolio companies, like especially abhi jaise downtime chal raha hai for VC funds. So investments are very slow. So there are many times that actually working on the strategy of portfolio companies, closely monitoring the portfolio operations etc of the companies. So a lot of times that role is overlapping, but some funds might have a dedicated operating team. Like PE funds have a very dedicated operating team. VC funds, the big ones who are leading etc, might have one or two dedicated operating people.
Okay, thank you.
Yeah.
Also, in these strategy teams, are CAs recruited normally? Like if you
Yeah. Nowadays, CAs are coming everywhere, especially because of the breadth of knowledge and the business knowledge and analytical skills they have. A lot of VC funds are giving a lot of weightage to CAs, just CAs, even without MBAs. And yes. Basically, the answer is a direct yes to it.
okay, thank you.
Yeah.
We now come to an end to the Q&A round. Ms. Gupta, I wanted to take a moment to extend my heartfelt gratitude for your incredible insights and engaging session on venture capital. Thank you for taking the time to share your expertise and for inspiring us to explore the world of venture capital further. We appreciate the efforts taken by you to answer all our queries. Wishing you continued success in your endeavors, and I hope our paths cross again in the future.
Thank you. Thank you so much. It was a pleasure being here and interacting with all of y'all and very interesting and relevant questions. So love to see the thought process which was building in everyone's minds. While I was going through the presentations and questions, I was wondering if you guys are actually following. But I was super impressed to see the questions which came from y'all. And after this, if y'all want, we'll be happy to connect and help y'all with whatever queries you guys have. I would love to actually, possibly do an offline with you guys whenever possible because it's always good. But I think there were some limitations from offline. But yeah, I enjoyed this thoroughly.
Thank you, ma'am. It was a pleasure for us to have you on board as well. I'd also request everyone to switch on their cameras for a group photo.
Thank you so much, ma'am. It was great to have you with us.
Thank you.
Hopefully we will try. Hopefully we will try for an offline one soon.
Sure.
That's it for now. It was a pleasure to have all of us on board. And that's Meg Mehta from the MCom Committee signing off.
Okay, great. Thank you.